Alright, we are recording. So let's start off with today's trades. I believe we started trading right at 950. So let's start from there. Now going all the way to 950, we woke up, we saw price made a new low, and right after making a new low, it invalidated this CB. So after the invalidation of that CB, and of course how we made a pretty firm move to the upside with the 950 candle, it is easy to assume that, okay, we've ran through three bearish confluences, right? CB1, CB2, technically the BPR as well. Three PDRAs, we should go to potential upside. Thing is, we already took out this internal, we already took out the external buy side. So when it comes to entering in a situation where external buy side is taken, it's a lot more riskier. In this sense, I thought that because we did such a firm move to the upside, it was still going to be respected. We had a couple of things here at this moment. What we had was TMSO. So my assumption was that, okay, well, we invalidated the bearish stuff, probably just going to grind up and rally, make more all-time highs, NASDAQ usual, retrace here, and shoot up. Now I was wrong, clearly. Price had other ideas. Specifically, Price wanted to pursue downside liquidity down here. This is why the stop loss will always be your little guardian angel when it comes to certain things. I ended up getting hard stopped, but ideally, I could have exited a lot earlier. I didn't have to necessarily wait for the hard stop, but that's why it's always there to kind of protect you from things. In this scenario, it ended up protecting me from a little bit of extra points, but I did get hard stopped out once price took out this low, and it's one of those unfortunate scenarios that even though you have the model at hand, you visually see everything right there and it gives you the confidence for the entry, it just won't work. You're at the wrong side, or simply the market wanted to do a bit of manipulation first and run over your liquidity. And it's important that even if you're wrong once, twice, or even 3 times in a row, you don't lose your cool. You want to keep yourself sharp. You want to keep your mentality firm, knowing that, okay, whatever, I got stopped out, I'm starting red, I'm just going to keep doing the same exact sizing, aiming for high reward, low risk. I'm not going to let it break me. Now, since the bullish setup failed, and we had displacement lower, this firm candle to the downside, what was the next assumption? Okay, well, we're going to go for lows, right? We're going to start moving even deeper towards the downside and potentially reach all the way down here. That was the assumption. Now, of course, price didn't do that either. I was wrong twice. Now, hard stop technically should be the swing high of the range, so it would be here, but right around here we had 953 root candle. So that was more important for me. If it had closed above it, it simply meant that price was going to go all the way up here. That, from my entry, would have been a stop of 32 points. Something I'm not comfortable with. It's too wide. So I made my risk management based on how the 953 candle, which was around here, looked. I remember that price closed above it, and it kept struggling to push lower with price respecting. Just delete the drawings. With price respecting this BC right here after inversing the CB. So everything right there kind of told me that price has a nice chance to push higher. And I didn't want to risk that, especially after already taking a loss. So it's important to always try and have that proper risk assessment when you're in a losing trade as well. Identifying if it's worth risking the capital you have, or if it's worth being a little bit stubborn when it comes to exiting the area. But the one thing that you don't want to do is have a clouded judgment and hold your losing trade stubbornly because you want it to work. Things are never going to go the way that you want it to. So it's important to know when to just call it quits and take the kick on the chin. If you're unable to learn how to take the kick on the chin, you're going to be compounding more losses than you compound wins. 2 losses. Especially, this one was a little bit annoying because right after it did end up selling off a little bit, so it would have been green anyways. but it happens. Third outcome. Why did I enter short? Well, it was essentially how price failed to displace higher. After it ran through our two bearish PD arrays, made a bullish structure, tried to go higher but failed, and then displaced back down lower, it seemed kind of evident that, okay, we might use this SABI right here to now take out these sell side liquidities. Especially because when we pushed down here, we never took out this liquidity right here. We were close, but we didn't take it out. So there was a chance that price was going to likely come back for it to wipe it out before doing a real move. With that likelihood, since we were still struggling, because keep in mind it was still a little bit iffy. At that very instance, there were two PD rays fighting each other. This tiny busy right here and the SABI right here. But every time price came back to this busy, it struggled to displace higher and invalidate the bearish setup. So keeping that in mind, there's struggle for price to push higher. Right above, we also failed to displace once, not once but twice. We failed to displace higher here, in this area, and then we failed to displace again here, in this area. And now we're struggling to displace higher a third time in a row. So that's giving us clue this price is simply not bullish enough to push towards the upside like we want it to. In this instance, the risk was pretty minimal, right? We were around here, and using the same confluence as before, 953, we determined that if price closed above 953, we would exit, otherwise we would hold the trade for the downside move. A 6-point stop targeting, I think we were targeting midnight, so it's almost 40 points. It ended up hitting 40 points, but I remember I exited for around 37. So it's a pretty good risk to reward. That was the thesis behind taking it. Simply, price failed to expand 3 times in a row to the upside. There was bearish confluence for the downside, so it was the best bet to take the short. And it was also the more probable and the less riskier to take. That set us back in break even. And then we have our little long here that we took. It was the fact that I believe midnight was around here, and we were just absolutely respecting midnight like if it was a wall. Every time price came back to midnight, it was just wicking and pushing right back up. And it was a little bit sketchy, right? We had the SABI right here. We were kind of respecting it, but every time it came right back up. It was one of those instances where the risk was based on how price reacted to midnight. I held with the presumption that it made an inducement to then go higher, which it did, but the hard stop would have definitely been this sell side right here, because if it takes that down, then I'm simply wrong and price is going to continue going lower. Obviously, there was all the confluences as well. If we look at the 5-minute time frame, in that very instance, we noticed something from the wicks. Every single 5-minute wick in this area was respecting midnight time, the midnight line, to push up. Every single one. It becomes a little bit crazy because if it's respecting it so much, why is the 5-minute candle not pumping? But you can expect that it might try and lead to that little push right back up. So that's what made me essentially trust in just holding the longs, waiting for the manipulation, and also just having that sizing risk management when it comes to how price reacted to midnight. And that's what led to us holding and pretty much making the run all the way to the buy side liquidity for 40 something points. Now, a key thing is it's always important that whatever model you take, whatever setup you take, you always have the same sort of approach when it comes to your sizing and when it comes to your risk. Ideally, any trade that you take, you want it to be at least a 1 to 2 risk to reward or more if potentially, because that means that you have more room to be wrong, but if you're right once, you're solid. You don't even need to have a high win rate to be a profitable trader. You just need to be a consistent one. So I don't really know what my win rate is, but I know that I win more times than I lose, and that when I win a lot more than how much I lose. And that's ideally the approach that you always want to have. Because to have that positive expectancy, you want to make sure that you don't blow your account in one day. You know, if it takes you an entire week to build up your account, then it doesn't make sense for an entire week to equal 1 day of loss. Now that's, I'd say, the recap of the trades that we took. More specifically, we're going to be talking about how to use invalidation points to take trades. So, what do I mean by that? There are times where price will give you the absolute answer in your face of what it's going to do, and you can take advantage of that to make a quick move to play that outcome right after you become stopped out. So kind of like reversing the position, but how do you tell when it's the correct move to do that, and it's not you just FOMOing into a position to make back your losses instantly? Well, there's going to be instances where the key PD arrays in price that need to be respected, and the very invalidation of those key PD arrays gives opportunity for continuation. For example, when we started looking for longs in the PM session, in the chat, I mentioned that price would likely come to this 5-minute fair value gap before the end of the stream. PM session, it came to the lunch session actually. It came to that fair value gap. Ended up respecting it and was trying to make an attempt to go higher. I went long several times because I did get stopped out in break even first before the long worked out. But it was with that thesis that price is going to attempt to go higher. Now I made an early entry here. It rallied a little bit, but what was the key point in here that was going to determine if price was truly going to go all the way to the upside, or if it wasn't, was this key area right here that also had 953 with it. The invalidation of this SIBI was important because it means that if this is disrespected, price is likely to go here, and this is quite the range. So from this point to this point, there's a high probability if this becomes invalidated. So let's say you go short here, right? You get stopped out, you see that it's disrespected, and there's the chance for price to continue going higher. Ideally, you can try flipping positions to now go for the opposite draw. And that's ideally how I also do some of my trades. The moment I notice that, okay, I was wrong, I can immediately flip over. It's important to try and do those sort of things to avoid also FOMOing back in to the wrong trade, because just as much as this like pushed down right after it did this dump, it made this SIBI right here. Now this SIBI is a tricky one because it looked like it was going to sell off, right? But it didn't. Ended pushing up right towards the upside. So if you got stopped out here in this key area and you see that price closed above, but then we knifed down, you might feel like the rush of FOMOing in and getting back in the short right here for an attempt to move right back down, only to then realize you're wrong. It happens quite often. It can be very tricky, but ideally this is why you want to have those specific invalidation points in your thesis. If you see your thesis become invalidated, instead of FOMOing back in, you can take a minute to tape read, gather more data to analyze things better or get a better read so you understand what's possibly going on, and that way you can make the correct form of judgment right after. What could have been an alternative here is, okay, I'm seeing that we invalidated the 1 minute, but we're in this SIBI right here. How likely are we to go lower? Well, if we look at the 5-minute time frame, in that very specific moment, we're fighting this 5-minute SIBI, but we just came from this 5-minute busy right here and this 5-minute order block right here to push up. It's a little bit conflicting. If we use in Confluence as well, the premium to discount fib, we came all the way to OTE before trying to push higher. There's that as well. If you look at it from the 15-minute standpoint, we came to 15-minute fair value gap to try and push into another 15-minute SIBI. So there's definitely things conflicting right there. Recommendation, in this case, is if you were to enter here the short, your stop would be the invalidation of this PD array, because this is the only thing in the 1-minute time frame that is hinting that price might go lower. And if this only thing fails, then the only answer is that price is going to go up here. So how can you manage this? Well, let's say you get stopped out because price closes above right here. What's the next PD array that you could go long on? this volume imbalance right there, the fact that it got inversed. Price retraced right into it, you could slap it there knowing price has inversed the SIBI, it's invalidated the bearish setup. Only potential outcome after invalidating the bearish setup is price to reach this PD rate. And that's a good chunk of points that you can make in that push right there. And if you happen to be right about the draw of liquidity, you can make even more. So it's ideally identifying invalidation points in your current setup, and if they come true, taking a calculated risk to play the opposite direction where it practically seems like, okay, this is definitely going to happen, because it's very likely since everything else is confluencing towards the opposite, and this was the breaking point for the setup at hand. Similarly to right here, we were super close to the buy side liquidity. We didn't take it out though. Price was a little bit of a jerk, ended up inversing here, and price sold right back down. Hit here, then pushed right back into this SIBI right here. This is one of those scenarios that, let's say you got stopped out in that drop right there, but you're still bullish, you still think that price can go up here. The way that you can manage to look for a new long is the invalidation of the SIBI right here. If price invalidates this, it's a no-brainer that, okay, it invalidated the only bearish structure it had, so it's likely to now go towards the buy side right here. So instead, I can wait for this to happen before I attempt going longs again. Otherwise, what could happen is what happens a lot of times, that people immediately slap in, thinking, okay, it's going to run now because they ended up respecting this one, and then they receive this trap where it knifes right back down. Stops you out. Any questions so far? Alright, seems like there's no questions. So similarly, all of this trendline liquidity that was being built, we moved quite a lot. Okay, but going to the PM session. So similarly, we have this scenario right. Trying to look for another example. I guess this one kind of work. Price ended up shooting back down, made the SIBI right here, respected it for the first half. Do you take that as a short? Ideally not, because you want to make sure how much liquidity is taken out beforehand. In this entire move down, we ended up wiping out all of this sell side liquidity right here. We did not take out the external one, but we did wipe out a majority of the liquidity that we had right here, and we went from a premium all the way to discount. So to look for shorts again, you would want it to be within premium range, not discounted level here. So this was one of those, again, tricky scenarios that you kind of want to wait for price to respect. And since it didn't respect it, pushed all the way right up, disrespected it, made a little busy right after disrespecting it. What's the logical outcome? Okay, we're at a heavy level of discount, we wiped out all of this sell side, we've invalidated the only key PD rate that could have led to continuation towards external liquidity. Price is likely going to try and come to a premium or try to reverse. So, if it's going to come to a premium, what can we expect it to hit? This SIBI right here. If it's going to reverse, we can expect it to hit buy side liquidity. So this could be another opportunity right here. The moment it invalidated this, you look for your very first confluence or whatever confluence you want to use. In this case, we had a little busy right there. Tapped right into it. You can exit your, let's say you entered short here. You get stopped out, you re-enter, but as a long, knowing the price has a good opportunity or probability to now go into this area. And although it's a little bit aggressive, you could have done that, exited majority here, stopped out at break even because that would have been inevitable, simply because it was not a reversal, it was simply a retracement to premium before coming to discount. Yeah, there's different forms of targets to have. Sometimes price won't take out the wick, sometimes price will just take the body, or sometimes price will just tap the 50% of the wick. It is hard to determine which one it's going to do. Kinda really depends on your trade management. I know as Sleepy mentioned, JD loves to target the bodies more than the wicks. I like to target the wicks, but there have been times where NAS is super super close, but it doesn't tap it, and then I end up getting stopped out of break even. It's just one of those scenarios. It's something that definitely comes with experience of identifying when it's good to make that flip. I would say the days that you don't, actually no, this is a bit more of a tip. If let's say this exact trade right here. No. Let's compare this exact one right here. What do you do in the scenario where this happens? Let's say you entered short here. You get stopped out, so this didn't work. Oh, it inversed it. Has this area that gonna come up here. I'm gonna enter long here. And then it doesn't even reach that area. Let's say it didn't reach this area right here either. It did here, but let's imagine it didn't. Immediately pushes right up, then pushes down. And you get stopped out here too. What do you do in that occasion? That usually happens during choppy or search and destroy markets. And if that happens, it's a clue that you kind of want to stray away and wait for greater data. So there's a difference in waiting for normal data is the sense of just 1 minute structure to develop and give you guidance. Greater data I would refer to it as like something to happen in higher time frames to give you a way clearer picture. Because this sort of thing usually doesn't happen unless it's choppy or it's not seeking external liquidity. If price is not seeking external liquidity, you can expect this. This is a nice little example right here. Let's say you went short here. You obviously got stopped out with price making the high, so you stopped out right there. Okay, price made the high. Oh, it's retracing now into the inverse right here. It's respecting this fair value gap right here. It's probably going to make more highs. Let me go long. Stopped out with the knife right down here. Oh, it stopped me out again. Let me try going short now, because now it looks like it made a market structure shift with displacement, right? This looks like a 2022 model. So if it stopped me out in longs, let me try shorting again. You enter here. Let's say you had a tight stop loss, or wherever you entered. Price runs right up. Let's say you had to stop at the body of the candle. You got stopped out third time in a row. So in my opinion, and it came right back down again, right? So it came right back down again. Let me see. Let me try going long here. Let's say you had a tight stop again, stopped out. It's just when choppiness, it's aimless. So in choppiness, I would not recommend doing the sort of reversal to your invalidation point, because you can get chopped up in those senseless movements. I'd recommend you do it only in good price action, where it is evident that it's going to go towards a certain draw. So for example, the long right here, I took this because it was evident that price wanted to go for the buy side. Now I didn't take it, but it seemed quite evident that I was going to expand as close as possible towards it. So this to me was more trustworthy to go long right after getting stopped out in short for price to go all the way up here. This, on the other hand, its choppiness is showing you signs that it doesn't want to go either way, so you can avoid those extra losses by being more patient and waiting for greater data. When I try to do reversal trades, I'm just going to call it invalidation trades. When I try doing invalidation trades, I limit it only to 2. If I'm wrong the first time, and I'm wrong the second time, it's a clue that price action is bad, and it's not my yeah, it's not your fault. You can't always expect for your trades to win, so it's a nice little heads up that, okay, price action doesn't really have a clear draw. Be patient. Wait for something better, rather than forcing something else to come out of it. And it's important to have the same sizing, right? Because if you start over leveraging, then you're just going to make a deep hole for yourself. I think that's the advice for that topic right there. Or if you guys have anything you'd like to talk about specifically, we can go over that. So let's see. Greg some insight on how to know when to move stops to break even or higher. Ideally, when it comes to break even or higher, you want to base it out of every swing point that is broken or that is newly made. So let's say we had this, Greg. How do we manage this? Let's say we go long right here. Change the color. So let's say we go long right there. The moment you put your stop to break even should be when, if you're going long when new highs are made. So the fact that we made a new high right here, that's the first expansion, and it's the taking out of internal liquidity. You gotta know that every time we take out internal liquidity, the probability of continuation decreases. That's why ideally after when external liquidity is taken out, you don't see people go long, because longs have already banked. So that's how I do it. Whenever a high or a new low is made during swing points, that's when I move my stop to break even. But what about trailing it up into profit? That comes with every new continuous high that is made and every manipulative swing down that is made as well. So in this case, let's say there's a fair value gap right here. Price push lower, expanded once more, new high. That means that price should technically not come back down here, so you can raise your stop into here, the very swing low right there. Expansion again, buy side taken, retracement into whatever PDRA, could be literally anything. New swing low is made, you raise your stop to this swing low right here. Now, there is a little bit of a scenario where an inducement might happen, right? Stops you out for break even and shoots you up. So what would I recommend doing to avoid those inducements? That's why I recommend you only do it when liquidity is taken or liquidity is broken first, and then you raise it. Because an alternative would be something like this, where price does this, but as it retraces, it never took out that liquidity. So when it tries to push right back up, it does this first, and then do it. So this would be an example of an inducement right here. So because price never broke, never made new highs, I don't raise my stop to break to higher lows. So I don't raise them to these lows right here until new highs are made, until there's BOSs, right, break of structures. So that way I can avoid becoming a victim of a quick inducement before it does its move. It's just a little thing I do. Yeah, ideally those would be hard stops for trailing upward your trades. Limit orders. But you could technically do them as soft stops as well, candle close stops. If you're actively managing it visually, looking at it, you could do it just visually watching it and you're like, okay, it closed below it, it didn't close below it. That's how you can also do it, just based on your confidence in it. For a 50k account, what's a good loss that you realize? What's a good loss that you realize you should stop? I'd say if you're doing 5 micros, you should stop after losing 50 points. If you're doing 2 to 3 micros, you should... No, actually, I think you should just stop trading if you lose more than 50 points in a day, regardless of sizing. I think it helps you have more opportunities to be wrong in the future, and it's also something that can easily be made because of how volatile Nasdaq is. But after you cross the 50-point mark, it also does something to your head, because then it's like, oh, I need more than one good trade to be back at break even, or oh, now I need to size in double, so instead of 50 points I have to make back 25 points too. So I recommend you only have a risk of 50 points a day, but with your sizing it's either 5 or 3 micros. What's your average stop in points, or do you prefer structure for stop loss placement? It's structure. If it, I have a rule where I don't lose more than 50 points a day, but I do know that sometimes Nasdaq does swing points that are relatively greater than 30 points. And in scenarios like that, it's like, well, man, if you're wrong once and you're wrong twice, you're gonna stop like that. Despite, in that case, I do size in a lot less. So if it's a 30-point stop, I would size in, instead of 5 micros, I'd size in 2 micros. That way, me getting stopped out in 30 points feels like if I got stopped out in 15 or less points. You get it? So the risk is decreased a lot more, and it gives me more room to be right or wrong in the future. And if I do happen to rewrite, I can see to potentially average up, or I can just hold the trade to whatever target I have and let it be. Yeah, it would have to be that as well. Ideally, you want it to be worth it with what you're risking. So if you see a setup right in front of your eyes, and you see that, I'm risking 20 points to make 10 points, that doesn't seem really worth it, does it? If it's a good chance, then I recommend you take it light sized. But overall, you want to aim for things that definitely gives more worthiness to risk. For example, the winning short that we took today, I was risking 6 points to make this short. So if you look at it from that point, it was like, oh man, to risk 6 points to make 30 something, absolutely worth it. But if I had my hard stop all the way up here, I was risking 26 points to make 31 points. If that doesn't really seem worth it to you, then, but you think there's a good chance of it working out, then you could size in a lot smaller so that if you happen to be wrong, it won't hit you as hard. And you can't force targets too. You can't be like, oh, my stop loss is 26 points, so I'm going to target 50 points. But let's say there's nothing at 50 points. So if there's nothing at 50 points, then you're not really targeting anything, and the probability of that hitting isn't really high. You want to make sure that what you're targeting is actually realistic. For targets, you can always target a PD array, a standard deviation, or an actual liquidity. When it comes to standard deviations, though, you want to target the fourth one. Usually. Any other question, fellas? Well, I think it would be a self-reflection. If you feel like you're having an issue in your trading and you feel rather lost when it comes to solving that issue, then you can always come to me, JD, or any other mod for guidance of how we would handle that issue. Because I'm gonna be straight up, I've been through everything that you guys have been through. I took the stubborn way with trading, and I went through all sorts of techniques. I went through everything by myself. So it is likely that whatever you have as a complication in your trading journey, I know what it is and how to fix it because I've had to go through it. So simply reflect. What's stopping you from being profitable? What's stopping you from being successful? And when you identify it, if you don't know how to fix it yourself, you can always come to guidance to find someone that has already done it. And yes, this is being recorded, Power Race. So far we've talked about using invalidation points to take trades, as well as how to manage your stops at break even or trail them higher in profit. Right now we're kind of in like the Q&A section. So that's a great question. How do you break the habit of being married to a trade? Do you feel like you're married to the bias that price is going to go to the draw of liquidity that you have in mind, or more itself that you just don't want to cut the trade for a loss? Yeah. So Nasdaq doesn't really care about hope, as we know. Recommendation for to get rid of hope is to simply see things as factual. If when price goes towards your draw, it's always going to have certain obstacles it needs to overcome. And if it fails to overcome those obstacles, it's just a logical response that, okay, it failed, it's going to go the opposite direction. An example would be, let's say when JD was trying to short, when price wanted to go higher here. He had this SIBI that he was trying to short continuously for price to go lower. In this case, what was the obstacle? The 5-minute bullish fair value cap. If price failed to break that 5-minute bullish fair value gap, the obvious answer is that price was going to try and go higher. So as much as you might want to go, let's say, short in this scenario, you have to know that these are factual things that happen with the algorithm, and that if it simply respects it, it's not going to go your way. As much as you might hope, or you might see that, oh, it did it once, it could do it again, it's not a healthy mindset to have. You really want to know that just accepting the red, just accepting the fact that, or just taking the small profit that you can, is better than exposing yourself to the outcome of being wrong. And it's uncomfortable, right? It's uncomfortable to have to just like press that one button to exit when you know it could go higher and you're kind of like a little bit greedy for those gains. But that uncomfortableness is something you're going to have to embrace and do it actively to break out of it. So every time that you take a trade and you feel like taking a picture of the trade, that's a good sign of you to get out. Or when you're taking the trade and you feel that uncomfortable, like, oh, I don't want to close it, in your head you say that to yourself, you don't want to close it, but you're worried or you're scared that this might be it, it might just go against you, that's a good point to exit majority. Hold maybe one contract, one runner, two runners, and see if it does. But if it doesn't, you're not worried because you already secured majority of the trade. Are you guys shorting right now? Or is that trade of today? That's also a good point. That's actually a great point from Kang. Hope goes in hand with too much leverage. If you have small leverage in the position sizing that you're taking, you don't really use hope, you just use logic. If it hits, great, you made some gains. But if it doesn't, alright, you lose a little bit. No stress, right? So that just automatically pushes out the hope that you might have. And I know that you tend to go for the big trades, the gap. You tend to look for those big winners. So I think it's good to keep in mind your sizing when it comes to certain things to avoid that hope that you might have, or that marriage that you have to your trade and not being able to cut it because you just want more and more. I I recommend try having a candle close stop loss. Greg, try experimenting with that. See how the results change by having a candle close stop loss, with your hard stop being the absolute invalidation point of the trade. Okay, so that's another good issue, Slippy. So I get it for sure that you're afraid of being even more red, so you don't even let the winning trade run. But I would say for this specifically, it's all about trusting your system. If you have a system that you see works, see that's the thing. I feel like you kind of depend on the signals a bit too much. For your individual trading, you have to have your system where you build the confidence to just simply continuously do it repetitively to the point that you can trust it. Because if you're basing your trades out of just me or just JD, then you're letting your emotions interfere too much into it, because it's not your logic, it's not your brain thinking, oh, I agree with the trade these guys are thinking. It's more of, okay, he thinks it's doing it, I'm gonna do it. And then your emotions are the one in control instead of your logic being in control. So it's a lot harder, and I get that because I've been there with when I used to take signals from people. But you gotta definitely trust that if you're risking 15 points, you want to try and catch the actual draw, not just, oh, I made 15 points back, I'm gonna cut here just to decrease my red. Otherwise, you're technically having a negative expectancy. You're exposing yourself to more risk than profit that you're making. And the over leveraging is an issue. The fact that you follow JD to the T, but your sizing was so bad that it could be classed as piping. Yeah, you gotta manage sizing really well. Like this experiment that I'm doing with you guys is to show you that with constant sizing you can have a profitable day. I was down 35 points and then I ended up being up 57 points in the day. Same size, didn't change anything. You don't need more leverage to be successful. Or when I got my 20 PAs to payout, I didn't use high leverage. I grinded it up, small size. You want to try and make it all seem more mathematic, Slippy? Let me go over the other questions real quick. Can you do a dummy drawing of the invalidation setup instead of a chart? Yeah, I can do that real quick. So let's draw it right here. Let's say we have a 2022 bearish model, but here we had a fair value gap. So logically, right, we see, oh, this is the stop rate, this is the 1 minute market structure shift, we hit this fair value gap, doesn't matter, we have a SIBI right here, this is a 2022 model, price is likely going to hit this and then sell off, right? But let's say in this 1 minute 2022 model, this right here was a significant 5 minute fair value gap, an important one. So we tap that and we disrespect this SIBI. This is a key PD array for the bearish 2022 model to work. And if in this instance what we had right here was some buy side right up there, and this is the only bearish structure that is in view for price to justifiably move down, if this becomes invalidated, logically we should come up here. So upon the invalidation of this bearish 2022 model, you can look to use, let's say in this case, the inverse here to pursue that draw right there. So even let's say, hypothetically, you went short here, you got stopped out, and then you entered long. You made back the loss you had using the invalidation of the setup that you had, and the logic, right? The logic that the narrative is bullish, the logic that you've witnessed high time frame be respected, and that there's nothing here that could potentially send it lower because the only thing that was there got broken. You get it? Now, Kank? Alright, can you briefly describe your system? Personally, I've been struggling, feeling like I have too many system models to see. I'm a really basic dude. I am super basic when it comes to my model. Everyone has the kind of like their own gimmick, but for me, it's like the very most simplest thing. I wait for the draw of liquidity to display itself. I wait for the invalidation of the opposite PD array so that it gives me extra confirmation. And if any sort of 1 minute model appears, 2022 model, unicorn model, inversion model, whatever, if it just appears in the 1 minute time frame, I'll take it using confluence of the 5 minute, 15 minute as structure and trying to target the 4 hour expansion. It's super simple. And of course I use digital time theory if it happens to mesh with my structure. So from your issues, we have to have more talks about your issue, Slippy, because that's something, in fact, you should schedule a one-on-one with me so we can have a more intimate talk about your things, because that you're definitely a very emotional trader. From what I've known you for so long and everything, you're definitely an emotional trader, and that's what's holding you back. And we gotta talk through that and have an actual trading plan for you. So I would encourage that you talk to LMT or Ken to schedule a one-on-one so we can go through that. Oh yeah, all of the one-on-ones are like a little bit public, but I'll be like talking to them directly and you guys will just have to observe. Lately, I started seeing fair value gap being inverse, but then price moved away, respected the fair value gap. Have you observed this? Yeah, usually, well, recently price action has been so nasty. I think that has happened in various occasions, and it's one of those situations, which is why it's important to have the 5 minute and the 15 minute be your confluence for what price is doing, because that way you have that extra boost of, okay, yes, this 1 minute is not being respected in this 1 minute PD array is not being respected, but I have these other things that are telling me that it's okay, rather than just completely depend on the 1 minute, because then in that case it becomes very iffy. How do I overcome the issue to make sure I wait for liquidity? So at first I keep forgetting that and I want to kick myself. So what you should do, go into text, put anchor text, write it down here, and then it's gonna follow you around so that you can consistently make sure to wait for that sweep. That's what I did to make sure that I would not forget how to do the 2022 model when I was first learning it. It's little cues like that, but the more you remind yourself and the more you make it a habit, eventually it becomes automatic, like brushing your teeth. No, it's not just add to text, it's anchored. So you go here, anchored text. That makes it so that wherever you place it on your screen, no matter how much you move your screen, it's always gonna be right where you placed it. So in fact, if you guys are struggling with your rules, I would encourage that you put your rules in like a little list with the anchored text. 1, 2, 3, 4, 5. And that way it follows you around and you don't forget because you're always looking at it. Parves, I would encourage you to watch the video I uploaded yesterday because that's where I taught someone the very basic 2022 model since he was a beginner. So I think that's where you can definitely just learn what you need to know about the 2022 model real quick. Alright guys, so we have done the hour. I do have to hop off now. I hope you guys learned something new or you learned something that was insightful for you guys. Next class will be on Wednesday. So if you guys feel like there's something troubling you or if you want to learn something new, feel free to save those questions for Wednesday or to just ask me during stream because I'm also there at service. And if you feel like you're dealing with something much more personal that you can't really combat during classes like this, that's more public, you know, I always encourage the one-on-ones. It's always tailored to what you're dealing with at hand. With that being said, I'll see you guys tomorrow. Have a good one. Bye bye.